I'd love to try to get bullish at the right time and be a contrarian bull. There's nothing better than being a contrarian bull and being right. I think the answer is the economy's slowing, and I think for it to recover, you need to shift from this tariff narrative to regulation and tax extension and AI deployment and other things. And I think we're still a few months away from that. And I think it's because you saw earlier in the week here, the market sell off hard when it seemed like President Trump was really openly saying Chairman Powell should be fired and being aggressive. The president is out pressuring Powell to cut the front end and calling him Mr. Too Late or whatever he's referring to him as.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I'm the host of the show. Today, I'm really pleased to be invited Adam Parker to the podcast today. Adam is the founder of Trivariate Research and he comes with extensive experience in the markets. It's a pleasure to welcome you today, Adam. How are you?
Wonderful. Thanks for having me.
Yeah, everything's going well in New York?
Yeah, we've had a very interesting 6 or 7 weeks in the U.S. equity market, so there's been lots to discuss with our clients.
Awesome. Well, I'm really delighted to welcome you today. It's going to be a really great chat as things have been very lively and very volatile recently in the market, so it will make for a really good conversation. And I just want to start off like I do with all of my guests, just to get a little bit of a background into you and some of your experience and also what you do at Trivariate Research.
Sure. So my background is I have a Ph.D. in statistics. I was hired at a boutique firm called Sanford Bernstein, which is now part of a public company called AllianceBernstein. I first did quant research, and then I was a fundamental semiconductor analyst. So I covered U.S. large cap semis for several years, was a number one ranked analyst for many years, briefly ran research at Bernstein, and then switched to doing more macro strategy and quant research. I was a U.S. equity strategist at Morgan Stanley for a number of years, which included running global quant research and sitting on an asset allocation committee, which they have, at that time, I think it was 17,000 financial advisors and a couple $1 trillion under management. It's much bigger now because of E-Trade and the like and market appreciation. I went to the buy side for a few years, and then I started this business 4 years ago. Trivariate Research is a product we sell to institutions. Trivector is to individuals and financial advisors. So if anyone cares about U.S. equities, they can just go to trivectorresearch.com and subscribe. It's $100 a month. You get our insight publications, monthly webcasts where you can ask questions, a bunch of ETF analysis and the like. So that's for individuals, and Trivariate's really for institutions, where we do capitalize on this big database that we built and do a lot of work on management, decision-making, risk management, idea generation, tech strategy, equity capital markets, that kind of stuff. So we're really U.S. equity focused.
Yeah, I know that's great. It's great to have a service where there's so much noise in the market at the moment. So it's hard to pick out what's relevant information and what is just noise, right?
It always is, and it's a little bit more than normal in the last few months, just because there's a lot of uncertainty about earnings and maybe when earnings troughing and the impact of the tariffs and policies on earnings and what might a recovery after that look like. So there's definitely a lot of uncertainty. And then I'd say even in earnings season, as we record this, we've had some data points that are a little bit better than people thought and some that are a little bit worse, right? So I think trying to make sense of how it's impacting companies in what order has been challenging.
Yeah. So obviously we've had a tough year in the equity market so far in 2025 after a pretty good 2024. We've seen some of the Magnificent Seven, a lot of them have taken a tumble. And I think the NASDAQ, I'm not sure the latest figure, but it's about 20 or 22% down on all-time highs. What do you think has been driving the slowdown in stocks in 2025? And what's your kind of overall picture of what's happening at the moment?
Yeah, look, we, after being really bullish on U.S. equities in 2023 and 2024, we came into this year, and our year had outlook in early January, saying we thought the market would be down and volatile in the first half of the year because things like tariffs and policies weren't in the price. And so that's unfolded. I'd love to try to get bullish at the right time and be a contrarian bull. There's nothing better than being a contrarian bull and being right. The problem is there's just a lot of uncertainty about the earnings path, the margins path, margins for companies. And then usually uncertainty means you pay a lower multiple. So I'm looking for some idea of what the earnings will look like. And analyst estimates are always too high. So the market can certainly appreciate even as estimates are being downwardly revised, but they seem particularly too high right now, given what I think is a bit of a consumer slowdown, et cetera. So I think the challenge is going to be looking for companies that miss and they don't go down a lot. That would be a clearing a moment. What I've done so far is I pushed my earnings out by a year. So what were my 2026 estimates in January? I've now made my 2027 estimates, just thinking that a reasonable base case would be to get rid of 1 year of earnings growth. And given the market's down a lot, probably my judgment is, maybe this sounds lame, but I think the market is down about as much as it should be, removing 1 year of growth, right? And so now we just have to see when do things trough and the like. But I think we're down because of the uncertainty and the impact of policy on earnings.
Okay. And in terms of the tariffs, obviously that was, well, I say it was a shock, but it really shouldn't have been a shock for many people who have been following Trump over the last year to 18 months. Actually, he's been talking about trade deficits for a long time, right? How significant do you think that the tariffs have been this year? And do you see a kind of softening of the stance? Because obviously there's a lot of focus on what's happening with China and the tariffs that are implemented on China and the negotiations with other countries. Do you think he'll start to soften his stance, or do you think he'll play it pretty strong?
It's hard to know. I think what you said is right, that look, he's talked about tariffs all the time, so it shouldn't have been surprising. I happened to be on CNBC the night of the election, and it was a whole big scene. And I had this epiphany. I wrote the next morning, by the election, saw the inauguration. It just seemed obvious that we're going to get all excited about the specter of policy and change, but there'll be a period of a hangover after the party where implementing this stuff is hard work. And I think even though we all knew there'd be tariffs, I don't think we knew the magnitude that there would be, some of the acrimony around the diplomacy and the duration, we don't really know. And there wasn't like a rollout or a strategy that seemed as maybe thoughtful as someone would have thought previously, right? If you really think about it, I happened to be sitting next to former Commerce Secretary Wilbur Ross earlier, about a month ago at a dinner, and he really coalesced things. I think you get somebody who's senior, been in the previous administration, telling you something with gravitas, and his view, which really resonated, was, look, we're not in a trade war with anyone but China, right? The U.S.'s economy is 10 times as big as Canada and Mexico's. Anything we do pro rata with them hurts their economies 10 times as much. That's unlikely to be a sustained issue. It's really more about China. And it's a little bit hard to answer your question, Stephen, because you've seen a lot of commentary that seems incongruous, right? 2 weeks ago, the president, Trump, said Mr. Xi is being disrespectful, right? And that seemed like a pretty big low point in the negotiations. Then yesterday or 2 days ago, he commented that they were making progress, right? Then China came out this morning and said, no, we're not making progress, right? So I think it's a little bit unpredictable. And I think the longer this lasts, the more damage it does to both earnings and the multiple you want to pay for earnings, because that multiple is associated with stability and confidence.
In terms of the price of equities and with correlation to what's happening with the tariffs and the uncertainty, do you think that the markets, from sentiment, do you think they're expecting that there's going to be negotiations and that there will be maybe lower tariffs negotiated in the future? Or do you think that they're more pricing in a more hardline approach? What's your feeling?
I mean, to be clear, like, I don't know what the administration is going to do. I have no idea. But I think what's priced in, the way you phrase that question, I think people assume there'll be this 10% kind of tariff on a lot of countries, maybe for the rest of the administration, but that most of the corporations can, and the overall set of earnings, can work their way through that sort of level of tariffs. But they also assume there'll be some resolution with China that isn't 100% plus tariffs and other things, I would say, in the next 2 or 3 months. I think if it lasts longer than that, I think there's real risk to the earnings and margins of a lot of businesses. And so I don't think the market's prepared for that sort of sustained level of intensity. I'd thought a week or two ago, maybe the second derivative or the rate of change might get more positive on tariffs. And you saw like one day where the stock market was up 10% in one day, which, is really like a full year of returns in one day. And then the next week it went lower again as people realized maybe it wasn't as close. I think what's in the price is that we do get a resolution with China in the next couple of months. And I think what's hard for me is to know, is second quarter the trough of earnings and I can start growing from that again? Or is it third or fourth quarter, because we remain in this sort of more tense situation. So look, at some point, I think the CEOs of the companies just have to run their businesses the best they can, deploy capital, deploy resources, whatever. I haven't seen a big fall off yet. The banks told you things were holding in okay. We'll see what the jobs prints look like. We haven't seen the weekly jobless stuff change a lot. I think the employment data will matter a lot. So maybe there's a lag, right, Stephen? Maybe there's a bigger lag between the tariff stuff and when it hits earnings. And so the bear case would be you're going to see a bit of a fall off in October earnings, not the July ones.
Yeah. And obviously there's been a bit of a spat as well. If we continue to look at politics, there's been a bit of a spat between Donald Trump and Jerome Powell at the Fed. And obviously saying that Jerome Powell said that Donald Trump didn't have the right to be able to remove him. And there was a bit of a back and forth from that. I think I looked at the poly markets today before this interview, and I think they were saying there's about a 20% chance that Jerome Powell is removed from his position. What's your views on that? Do you think that does cast a dark shadow on the US? Because obviously the Fed is supposed to be completely independent, right? What do you think that does to the market? Do you think it provides further instability?
I love that you reference the poly market because I look at it all the time myself. I think on the election night, it became the final nail in the coffin for me that the poly market was right in almost every situation and the polls were wrong. So I think the poly market is a great way to think about it. I actually looked at it yesterday, which is why I knew it was 20% on the exact issue you were talking about. And I think it's because you saw earlier in the week here, the market sell off hard when it seemed like President Trump was really just openly saying Chairman Powell should be fired and being aggressive. And I think that was part of the sell-off earlier in the week. Yesterday, part of the market rally here in the U.S. was the president seemed to soften his stance on that topic and say, no, the Fed won't be reporting to me, right? So it's a little bit of the same instability that we see with tariffs that we're seeing with the commentary on the Fed. My own personal opinion is it would be really bearish if you didn't see that independence. And I think the market would take a big step lower if that really turned out to be the path we were headed in. The president is out pressuring Powell to cut the front end and calling him Mr. Too Late or whatever he's referring to him as. And I don't think there's a lot of, honestly, when you call it a spat, like it seems like one way to me. It seems more, I haven't heard Chairman Powell say much other than was just going to react to the data and look at jobs and look at inflation. And I think that's what the Fed's going to do. Like they're going to react to full employment and stable pricing and the like. I do think if you take a step back and say, okay, well, what have the U.S. investors been programmed to think about? They've been programmed to think about V-shaped recoveries, right? And that's why you see the stock market go up so much now, anticipating that. But in the reality, the V-shaped recoveries we saw after the financial crisis, we saw after COVID, were because of two things, right? Monetary policy and fiscal policy. And if I take a look at both those things, with the Fed being on the monetary policy side, I don't know if they're going to cut the front end a ton unless they start seeing a real degradation in earnings and economic growth, both jobs and inflation. And if that happens, I think the stock market goes lower because it's not like, oh, the Fed's there, it's awesome. I think at this point in the cycle, it'll be, man, the Fed's there because things merit it. And I don't think they're going to do a lot of balance sheet expansion. If they announce a QE, I'll get bullish in a second. I'll write a note the next day because we've learned there's like a big week-over-week change in the balance sheet is very correlated to a change in the S&P 500. But it doesn't seem like we're at the phase of the cycle where they're going to do a lot of balance sheet expansion either. And then if you look at the fiscal side, like, isn't Doge itself like antithetical to helicopter money? So I think one of the problems or challenges that you got to think through is like maybe the fundamental and economic recovery, even if we do resolve this in the next 3 to 6 months, won't be that V-shaped in 2026 just because we're not likely to fuel it with a lot of monetary accommodation, balance sheet expansion, or incremental fiscal. And so maybe I don't want to call it a bathtub shaped recovery or whatever, but it might not be V-shaped.
So you think it's more likely, unless they pump loads of money into the economy, you think it's more likely to be more steady recovery, steady growth from there?
Yeah, exactly. It may not be V-shaped. It may be a little bit a longer recovery, slower grind higher. Now, there's some things that could help that, right? You get a weaker dollar, you get lower commodities as input costs. You get what we really want in the U.S. is the AI proof case where you have a company coming out, a Walmart or a big healthcare company saying, hey, we would have in the past had to hire a bunch of people to do this, but now we don't have to because we've gotten better at predicting our customer and employee behavior. Like if you get AI margin proof cases, look, if I've learned anything doing this in 25 years, like you don't short stocks where the margins are going up, right? So if we get on a different trajectory mentally, that margins are going to go up because of depreciation or input costs or materials or labor or AI proof cases, then yeah, it'll be bullish. But I don't think it's going to come, or at least right now, it doesn't seem like I should be positioning for monetary and fiscal accommodation to fuel the recovery.
Yeah. It was interesting what you were saying earlier about the poly market, because I agree with you, because it's always best to look where people are actually putting their money, right? Rather than just sentiment.
It's not a poll. It's not a poll where they could say whatever they want, right? They're putting their money there, right?
I agree with you. And I also saw when I was looking at them this morning, I saw that the likelihood of a recession is about 53% in the poly markets as of today. Do you think that's a likely scenario, and how generally be positioned for that?
I don't know, because that whole like 2 consecutive quarters of negative GDP or whatever the official definition of recession is, like, in a way, like the stock market's already had a recession, right? Like semiconductors are down 30%. So I think about it. Look, economists generally aren't that good at telling you what already happened. Forget predicting what's going to happen. So like, I don't know if I care if there's a recession. I think the question is like, how deep is it? When does it trough? How anticipatory should I be? I think the challenge, and so I focus on U.S. equities, and all I think about is like, how anticipatory should I be of that trough, and what do I want to own when it recovers, right? I mean, by the time the economists tell me that there was an actual recession, the market will be 50% higher, right? Like, it's just so lagging. So, I mean, I think like this isn't a growth scare. The growth has actually slowed, right? We already know that. We can see that through a number of corporate results, et cetera, consumer confidence and other economic data. So I'm a little bit less focused on like the 1980s, 90s way of thinking of like, oh, I need to know if the economist has negative GDP forecast. And I'm just more focused on like which businesses can operate with pricing power and efficiency over the next year, even independent of this, and which can. And maybe it's just a good stock selection environment. But that didn't really answer your question. I think the answer is the economy's slowing, and I think for it to recover, you need to shift from this tariff narrative to regulation and tax extension and AI deployment and other things. And I think we're still a few months away from that. So we could be in a recession right now, and the economists will tell us in 2026.
Yeah, that's always the case, isn't it? You only know about whether it's a recession after the fact, and you should have made moves before then, right?
Totally. The market's 3 to 6 months anticipatory. So the best idea I have that we could be in a recession is that the stock market's already down.
Yeah, I agree with you on that. All right, excellent. And if we go more into stocks now, and I wanted to talk to you more about the recent round of earnings and what's coming up, and what's your views overall on the earnings that are coming up. And also, I wanted to talk to you a bit about the incentives for some of the CEOs to give good forward guidance for their earnings, considering all the kind of negative things that are going on in the markets at the moment.
Yeah, so on that second half of your question, right, there's a lot of behavioral psychology involved there. I mean, I think it depends on your business, right? If you're idiosyncratic business and you say good things, you'll be rewarded. Like Eli Lilly came out, looks like their drug works, stock's up a lot because people can say, all right, it's not particularly economically sensitive, and I get an effective and safe drug is a positive. Perfect, right? But if you're more a macro sensitive security, I think the challenge would be a little bit of a Goldilocks, right? You need to set the expectations where people believe it's not so high that it's actually achievable and you're not whistling by the graveyard. But if it's really bad, people will say, whoa, you're seeing something that's falling off a cliff that maybe isn't really being shown by others. Look, if you look at the bank earnings, and they're really 10 days dated now because they're the earliest part of the earnings season. If you take in the U.S. banks, JP Morgan, Bank of America, Citi, Wells, Morgan Stanley, Goldman all reported at the beginning of earnings season. I actually thought their earnings and guidance were better than I would have suspected going in. In fact, I would have thought they would say, hey, activity in April has been weak, but it really wasn't true. If you take the kind of collective part of what the big boys said, consumer slowed a little in Q1, but they could have easily said, yeah, look, we had a decent Q1, but things are worse in April. They didn't say that. So I think the bank stuff was better than I thought, but I haven't seen companies that are missing. If you look today, it's pretty unusual for Pepsi and Procter and Gamble to miss in the same day. I was actually going to go back and look if that's ever happened before. Like it's like these are like the bellwether companies, and so I think you're starting to see some signs that the consumer is slowing through earnings, and then obviously companies that miss are really getting punished. And you've seen that. Software looks like it's holding up. ServiceNow's numbers were pretty good. Mart stock's up. But we're talking on a day where we have a lot of tech earnings after the close tonight and a lot in the next 3 or 4 earnings days. So on the tech side, I think we'll get more data soon.
Yeah, I think everyone's going to be looking at those Nvidia earnings and also the rest of the Magnificent Seven, right? They're going to be the ones everyone's watching.
Yeah, totally. Nvidia doesn't report for another month, so we have some time on that front. Texas Instruments was out with a number that was slightly better than people thought. I mean, it's a high quality business, but they have a lot of China revenue exposure. They have high inventory. They're not really an AI play. So I think people are trying to parse through what's believable, what's realistic. And then there's other businesses where people just know they don't have visibility. So Taiwan Semi, which is maybe the most important asset on earth, came out with decent numbers, but people just know they don't have a tremendous amount of visibility. So they're not sure how much they should reward that positive commentary that's out there. So we just need to get more industrial and tech companies reporting so we can understand what's happening with their backlog, what's happening with their order book, how are their customers feeling, like what's happening with their inventory, are they aligning production with consumption, all those kind of more important things to figure out the trajectory and margins later in the year. But I would say slightly better than I would have thought heading into the earnings season, mostly because the bank earnings. I mean, you can't assume that all the banks wouldn't have seen something in their credit card delinquencies or their lending books or something that indicated the consumer was slowing a little bit more, and they didn't really say that. So that's why I said earlier, like, how long is this lag between the plummeting consumer confidence and what it does to earnings? Is it really going to hit this quarter now, or is it 6 months lag? And so people feel like, oh, the worst is in, but really it's not till October earnings. It's the Q3 guidance, not the Q2. And by the way, the Q3 numbers, bottom up numbers, really hockey stick later in the year. So that's where you could have a more meaningful reset to the current expectations. That's a risk.
And considering where we are in the markets and a lot of the things that you just mentioned and the potential for a recession and the different earnings that are going to come up, which sectors are you particularly bullish about at the moment and why?
So our number one sector recommendation is healthcare. After really lagging the last 2 years massively, we sort of came into the year thinking that it was the one part of the market where investors seemed to be thinking that policymakers would wreck earnings, but that was unlikely. And that medium to long term, it was an area where there's lots of inefficiencies that could be improved. Last year, I took an AI for healthcare course at MIT, which is a tech college in Massachusetts, and I learned a ton, and I felt mesmerized by the potential for inefficiencies to be improved, whether it's in healthcare services or drug distribution or tool making or diagnostics or healthcare technology, hospitals, et cetera. There are just so many inefficient businesses. So what I try to do is screen quantitatively for companies that have lots of employees, high revenue dollars, but low margins. Just thinking if I were CEO of these companies, I would really try to predict my customer and employee behavior. So we started recommending stocks like McKesson and Cencora and Cardinal and Quest and businesses that maybe can grow for several years without a lot of net hiring of people, and they'll show some margin expansion, right? So McKesson is probably not a household name as a company, ticker MCK. They surprise some of your global listeners, but they do $350 billion in annual revenue. The reason you never heard of them is because they're a drug distributor that does 1% net margin, right? So they're a pass-through. But if they can get their business slightly better at predicting customer behavior and their margins go to 1.5% from 1, that's 50% earnings growth, right? So there's a lot of like potential upside in this sector from inefficiencies. You go to a hospital or a doctor here in America, most of them still hand you a clipboard with a pen like it's 1980, right? It's just crazy inefficient, right? So I think there's just a lot of upside potential on that. And revenue per share for S&P healthcare companies has grown every single year, whether it was COVID, whether it was the financial crisis, whatever. So You got demographics that are in your favor in terms of better estimate achievability. I don't think it's that easy to disrupt the U.S. healthcare system despite its inefficiencies. I mean, if you look at, some people forget, but Buffett with the Berkshire family and J.P. Morgan with Diamond and Bezos with Amazon about 10 years ago tried to create their own separate combined healthcare consortium, and they gave up because it just turns out it's really not that easy to change. So, I mean, we've had a couple of blowups in earnings with United Health, et cetera, but in the managed care space. But I look at this sector and think earnings are more stable, more achievable than average. They have pricing power. I mean, we have to use United Health at Trivariate for my employees. Like, there's zero chance they don't raise pricing on me next year. So and unless I go out of business, yeah, they're going to make more money for me. So I think these are better estimate achievability, and they play defense. If you want to get really frothy and optimistic, medium to long term, I just think there's a lot of potential for healthcare and technology to emerge. I think every new home that's built will have like a box on the wall that's almost like a giant wearable, and it'll be improving your chance to proactively know some of your medical conditions. So there's a lot of like technology upside as well. So I'm like tethered to this view that this is defense and offense as a sector, and given it's hated, that always puts a little extra hop in my step. My least favorite sector, our biggest underweight this year, has been consumer discretionary. That's worked, but I still think there's a lot of downside. We highlighted a couple of weeks ago that going from the easy shorts, which are things like Target and Dollar General and Kohl's, these boxes that don't grow, that have margin challenges, then maybe the next wave is to go for expensive consumer companies to short that have high expectations. We highlighted Chipotle. They reported last night and they missed. And these are companies that trade at 35, 38 times forward earnings with expectations they're going to grow double digits for the next couple of years. And they're not going to grow. They're growing low to mid singles. And why would you pay 38 times? So I think there's things to be really cautious of in the consumer space as it's declining. And so I've kept long healthcare, short discretionary has been our top kind of positive and negative idea.
Yeah. No, that does make a lot of sense because, as you said, people are always going to get sick, right? It's a pretty recession-proof area, and you always want to drive efficiencies and have more technology to make things more precise, but also make things more efficient. So that does make a lot of sense in that environment, and people are going to have less money to spend if there is a recession. So,
no, I was just saying, people have to remember with stocks that sometimes bad is good. Like some of these are bad businesses, but they could be good stocks because they're opportunities for margin expansion. I'm not saying in absolute terms I want a business with 1% net margin. I'm just saying there's opportunity for margin expansion. If the margins expand, the stocks go up.
yeah, I was going to ask you as well, with all the volatility that's going on in the market, how do you direct clients, etc., to how to navigate volatility in these types of markets? Because there's obviously a lot of people that get a bit nervous when the markets fluctuate so much like it has recently.
So two things. One, I think it's really hard to make 1 month market calls, right? If I took all the information that people have told me through the years and tested whether I could predict 1 month returns for the S&P, the answer is you can't, because a lot of things people think are negative indicators, bull bear ratios and implied versus realized vol and relative strength and the Kospi or whatever that people think predict. At the end of the day, those are usually volatility signals. And so if you think, oh, the market's gonna be down, I'll take my money out, you might be right, but if you're wrong, you lose more money than, over time. So I don't think you should make short-term market calls. I think that's a fool's game, to be honest with you. And then the second thing is like, it's really more about risk management and how do you position your US equity book to beat the index. And so you can participate when things are up, but not get slaughtered when they're down, right? And so the tried and tested view is you got to have some kind of barbell strategy where you own some defensive stuff. Maybe it's some healthcare I mentioned, maybe it's tobacco or things that are steady and staples, and then you take some offense. I think like the thing I've convinced myself on the offensive side is I studied the last 20 times the S&P was down 10% or more, and then what worked the 3 months after. 19 of those 20 recovery periods, tech was up. On average, tech was the best performing sector in the market. So if you really think that you want some offense, I think you have to figure out what tech you can own for that offensive side of the barbell, whether it's some of the software names that have done okay, whether it's even semiconductors, which are bombed out. I think you see on these up days, they participate at this point. So I think there's a barbell strategy of some high beta offense and some prudent defense that on average gets you to slightly beat the market in both market conditions.
And if we have a look again at that defensive play and we see what's happening with gold has hit all-time highs again and has continued to do very well this year, and it seems to be a way of a flight to safety. What's your views at the moment on the gold market, and maybe not only gold, but some of the gold equities as well? Do you see good opportunities there?
I don't have a strong view on gold. I think people are worried about the dollar. I think one of the more consensus trades right now is that the dollar will weaken. And so it's weakened against the DXY a lot this year, a decent amount against the euro. And so I think whenever you look at government spending and you look at government budgets and the like, you get worried a little bit about the dollar. And in a regime where there was like a deglobalization regime, I think people are thinking through other forms of currency besides the dollar. And so that means gold and that means coin and other things can do well. I don't think this is really that much about the Indian jewelry market or other things that sometimes can drive gold demand. So I think this is more a hedge on inflation or deflation or the value of the dollar. When you get extreme views of inflation or deflation, it tends to make gold bid. So that's my view. I don't really have a strong view on it. If somebody said, "Do you think I should have 2 to 5% of my net worth in gold or Bitcoin?" I would say sure. If it was 50%, I would say that seems crazy to me because they're not really generating any cash or whatever. They're not really businesses. And then the second part of your question is, look, the only thing I'd say, Steve, is I've been burned by the logic in the past that just because the gold price is up, that the gold equity should go up. They can have sustainable disconnects where even though you think that change in gold price should be correlated to the change in the gold equities, often there isn't. There's a lag effect between the price change and their fundamentals and other things. So I'm not a huge fan of the gold equities. I guess if you really have conviction on gold, just buy the gold because I've just been burned by that before.
And it also depends if you're in the camp where you think tariffs are inflationary, because some people don't think tariffs are inflationary. Some people think tariffs are inflationary. If tariffs are inflationary, then it should be pretty good for the overall gold price.
Yeah, no, totally. And then by the time you think they're going to catch up, the gold price rolls over or there's an economic. But the challenge with metals generally, just even forget gold, just go across the complex, is you could argue that in certain situations, the tariffs would be good for U.S. companies that make metals. And I could see that in a couple situations. I mean, the U.S. is less than 1% of global aluminum production and probably 17-20% of finished good consumption. So you could say, all right, this Make America Great Again might mean we build more aluminum in the U.S. and tariff stuff coming from Canada, India, and China. And so there could be a couple of aluminum companies, Century Aluminum, whatever, and maybe they'll benefit. And I could see that making sense. But the problem is metals don't act well if people are worried about a recession. Like that's just the fear of the demand fall off offsets this potential tariff benefit or whatever, right? So I think it's always like a 9 variable problem that we're trying to isolate to one. Oh, gold price up, me buy gold stocks, but there's like 8 other variables involved, and so it's not always that easy.
All right then, Adam, can you please explain for the listeners how people can find out more about you? What socials are you using, as well as a little bit more about the 2 companies that you're running?
Sure, thanks. Yeah. If you're an individual investor or financial advisor and you care about US equities, you should go to trivectorresearch.com, www.trivectorresearch.com. We sell for $100 a month, $1,200 a year, a financial insight publication. A couple times a week, you'll get either videos or a short research and content from us. We also do a monthly Zoom where you can ask me questions. We do a lot of ETF analysis. A lot of individual and advisors like to buy ETFs. And so even in the last couple of weeks, we've looked at SOX, the semiconductor index, XLP, the staples, XLF financials, the quality ETF, et cetera. So we do a lot of detailed analysis for that crew on exactly what they're getting with US equity ETF exposure. Trivariate's really our institutional business. So if you work at an asset manager that owns US equities, we can arrange a Zoom to try to chat, and you can just go to sales@trivariateresearch.com. So check us out on LinkedIn, check us out directly on our website, and we'd love to work with you.
Thank you very much, Adam. I've really enjoyed today's interview. We've got through a lot of different stuff, and I hope that you can come back sometime in the future and we can go into some more areas of the economy and the stock market.
That'd be wonderful. It was great to meet you, and I enjoyed the conversation as well.
Thank you, Adam. Speak to you soon.